Today we're going to go back in time to June 28th, 1919, the Palace of Versailles and the famed Hall of Mirrors, where on that day the Treaty of Versailles formally put an end to the Great War, the war that ended all wars, World War I. Now, even though the Central Powers who had lost the war had actually been formally excluded from the negotiation process, negotiating the peace treaty, it was only the victors, the Allied powers, the U.S., the Brits, the French, and so forth, that were negotiating the peace treaty. It still took 6 months to hammer out all the details. And so when they got together on June 28th and signed the peace treaty and formally put an end to the war, there was an interesting provision that was included. This was Article 231. And this was something that I could imagine was a pretty emotional provision to include in the treaty. Because when something like this happens, I mean, a war that was just so full of chaos and death and devastation, something that people had never even seen before. Bear in mind that up to that point, war is warfare. I mean, warfare throughout the 19th century. This was, I mean, you think about it in the Napoleonic days, and people rode in with their cavalry and maneuvered their units around the battlefield like chess pieces, and they would have a big battle and maybe another big battle, and that was it. You know, the war was kind of fundamentally over, and it was mostly about supply trains and logistics, and people out generaling one another and so forth. And then you had World War I, and suddenly there was so much just devastating technology and firepower, and they had tanks now and airplanes and massive artillery shells and trains to be able to transport troops and equipment so quickly from one end of a country to the other and get things to the battlefield to keep the chaos and the death and destruction, the devastation going. And nobody was expecting it. Nobody ever thought that you'd have millions and millions of casualties like that. And even a few months into it, people started looking at these major battles and said, oh my God, what was that? I mean, people just didn't expect in a million years that it would carry on like that it would continue for years and years, dragging out, grinding away with people just sitting there in the mud and the rain, hiding in trenches, while storms of artillery rained down over them constantly, day and night. I mean, that wasn't warfare. That wasn't the way it was supposed to be. And people were looking for somebody to blame. And so they put in this article into the Treaty of Versailles, Article 231. And it's commonly known as the War Guilt Clause, because they wanted to blame somebody, and they blamed Germany. And Germany, according to Article 231 of the Treaty of Versailles, had to actually formally accept responsibility for the war, which was an interesting point, given that the spark, the match that lit the fuse that set the world into war was actually a guy named Gavrilo Princip, who pulled the trigger and shot the Archduke Franz Ferdinand of the Austro-Hungarian Empire. It wasn't a German guy that got killed. It wasn't a German guy who shot him. But it was the Germans that got blamed and had to accept responsibility for the war. Now, from a practical perspective, that kind of made sense, because by 1914, before the war started, Austria-Hungary was already in a very weak position. They'd once been one of the dominant superpowers in the world and had deteriorated rather quickly, and by the beginning of World War I were pretty much finished. In fact, the Germans, who had allied themselves with the Austro-Hungarian Empire early on in the war, commented of their ally, the Austro-Hungarian Empire. They said, we were tethered to a corpse, because they knew that the Austro-Hungarian Empire was finished. And of course, they were tethered to all kinds of corpses. Most of the Central Powers were weak. They were economically weak. They were about finished. And so Germany was the only one left standing. They were the most powerful economy of the Central Powers, and they were the only one of the Central Powers really left intact at the end of the war. And so they had to blame somebody. They said, well, let's blame the guys that are left standing. It doesn't do any good to blame an empire that no longer exists. Let's blame the Germans. And they actually have the ability to pay. So not only did they stick the Germans with the blame, they stuck them with the bill and said, you got to pay us. And it was a lot of money. Not today. We don't consider it a lot of money. It's just over $30 billion. Today, that's chump change. They blow $30 billion on idiotic bridges to nowhere. That seems like the Obama administration will probably spend that much on the next website they try and build. But back then, $30 billion was a lot of money. To give you a sense of perspective, that was about 40% of U.S. GDP at the time. Bear in mind, U.S. GDP today is, $17 trillion? So you're talking 40% of that today is, what is that, $6.5, $7 trillion almost? I mean, that's the equivalent we're talking about. That was a lot of money. And of course, Germany didn't have it. They were already deeply in debt. They had borrowed a lot of money to go to war, to fight World War I, and they lost. And every other country, people had borrowed, they had taxed, higher taxes, higher borrowing. The Brits had discontinued the gold standard. I mean, the European economies were in tatters as a result of World War I, and they wanted to get paid. They wanted somebody to make them whole. Well, I mean, I don't know how you make yourself whole by going to somebody else who's already bankrupt and say, hey, you got to pay me. Because, of course, the bankrupt guy's not going to be able to pay you. What kind of sense is that? But that's what Article 231 was all about. They went to the Germans and said, you got to pay us. And so the Germans did what any other bankrupt nation does. They started printing money. Duh. They don't have the money. Where are they going to get the money from? So they started printing money. They started conjuring out of thin air. These paper marks, they started printing them, and sure enough, inflation set in. Wow, what a surprise. You start conjuring money out of thin air, bad things tend to happen. And it didn't happen right away. It happened slowly, gradually, then suddenly. And by the early 1920s, one of the most famous episodes of hyperinflation took hold in Germany. And back then they called it the Weimar Republic. And there are tales galore about hyperinflationary episodes in the Weimar Republic. There's a really fantastic book that I encourage you to read. I've read a lot of books on hyperinflation in Germany back then in the 1920s. But my favorite, far and away, most of them tend to deal with the actual kind of the economic history, the technical data, and all these sorts of things. And I'm kind of a numbers guy, and I really find that stuff fascinating. But there's a great book called Culture and Inflation in Weimar Germany. And this is a book actually about the people. This is about the stories. This is about, they went back and they looked at newspaper headlines and read diaries and all these things to cobble together this piece to try and really understand what was happening on the ground. And so many interesting stories. There's a great quote from the book, talking about, people and sort of the mental insanity that kicks in where, one day, and that's the thing about, inflation. I don't mean hyperinflation, regular normal inflation. You and I feel it, but we feel it over a long period of time. When I go back and I visit my parents in Texas, and we go to the grocery store I used to shop at as a kid, and I remember there's the Coke machine outside the grocery store. When I was a kid, you could buy Coke for 25 cents, and that's $1.50, maybe $2 now. And I remember thinking, man, I used to buy Coke for $1 for 25 cents back then, and it's just one of those things. It's a slow, gradual process where it eats away slowly, gradually. But that was 25 years ago. This is now we're talking about not just something that that's 8 times as much, 10 times as much. We're talking about something that's 10,000 times as much, and not over a period of 20, 25 years, but over a period of 20, 25 days. That's what hyperinflation is. They economists define hyperinflation as a certain high level of inflation. That's a nice, convenient definition, but really hyperinflation is when there's a complete loss of confidence in a currency. Hyperinflation sets in when there's an actual currency crisis, when the currency becomes fundamentally worthless. And that creates a sense of madness. When one day you pay 1 mark for an egg, and the next day you pay 10, and the next day you pay 1,000. There's a certain madness associated with that. And the currency, in many respects, is an incredibly important social technology for society. And when that technology breaks down, it creates a vacuum, really. In fact, when you think about money, when you think about savings, how many people sort of not only value goods and services, but in many respects even value themselves based on this sense of money, using this currency, using this social technology to actually value themselves, to denominate the value of themselves. And when that breaks down and that leaves a void, leaves a vacuum. And there's so many great stories. There's one quote in the book, and he's talking about this woman in a marketplace, a vendor who's out selling eggs, and it says, the market woman who demands in a dry tone 100 billion marks for a single egg had lost during inflation her ability to be amazed at anything anymore. The point being that prices had gotten so far out of control that one day you'd charge a 1 mark, then 10 marks, then 1,000, then 100 billion, all within the span of a couple of weeks, a couple of months. You cease to be amazed by anything. When you go in and you go to a cafe and you sit down and you order a coffee and it's 5,000 marks, and you sit there for 40 minutes and then you order another coffee and now it's 12,000 marks. Well, you've been sitting there for 40, 45 minutes, and the price continues to go up while you're sitting in the cafe. It's not just the numbers, but that begins to affect your psyche. And the easiest way to sum up that entire period of history until 1939 was that, as they write in the book, that there's a straight line that runs from the madness of the German inflation to the madness of the Third Reich. Because when you affect the psyche of an entire civilization like that, a whole society, which, by the way, was one of the most advanced societies in the world. When Germany was sort of created, they cobbled together Prussia and all these other German states and so forth and put them together and said, oh, Germany exists. And that was in the late 1800s. And it was almost overnight one of the largest, most powerful economies in the world. It was civilized and advanced and highly industrialized and productive. And you take a place like that, very similar to what Germany is today, many European nations, the United States, Canada, and so forth, Australia, all these modern, civilized, advanced nations. And all of a sudden, one day it's normal, and the next day the whole world's at war and everybody's fighting, and the next day you get stuck with the blame, you get stuck with the bill, and the next day a single egg costs you 100 billion marks, $100 billion, where they're printing and printing and printing. It was a very short period of time. I was looking at the history of the currency. I mean, it was one day they're printing 1 mark notes. And within a year and a half, they're printing trillion mark notes, hundreds of billions of marks. They don't have time for 1 mark notes anymore. It's meaningless. It's worthless. They can't print ones anymore. They got to print tens. They got to print hundreds and then thousands and 10,000 mark notes. And then they're printing million mark notes and billion mark notes. And it was at the point, there's a point during this episode of hyperinflation that they were printing so much cash or printing so much currency that they had an entire army of people that were going out, and they had 130 different companies that were under contract to produce this enormous quantity of money. They had paper mills all over the place. Banks had to hire droves and droves of people just to count paper money. This stuff has a massive effect on society. And so, of course, anytime there's a modern, advanced, civilized, wealthy country that all of a sudden gets reduced into hyperinflation like this, we're not talking about Zimbabwe. We're going to talk about some little backwater, impoverished nations. One of the most civilized, advanced countries in the world that gets reduced to this level of suffering. They're willing to give up anything: their sanity, their rationality, their morality, for a man on a white horse who rides in and says, "I will save you from your suffering." And of course, they're all linked. Of course, the rise of the Third Reich, the rise of Hitler, is linked to this kind of economic suffering. It was a horrible idea. And it happened. These things have consequences. And as we look over and over again in history, it's interesting that there are so many examples of advanced, civilized, superpower status nations that break down into these periods. It happened in France after their revolution. And they had an interim government, and that was short of cash. They said, "We need money. What are we going to do?" Oh, great idea. Let's create a paper currency and just conjure it out of thin air. There's another great book on that called Fiat Money, Inflation in France, talking about their episode of hyperinflation in France, where one minute you've got the price of eggs, and then the next day it goes up 1,000%. Where they have to impose capital controls, and they have to impose wage and price controls under penalty of death, and yet even still, none of that works. Then when you start messing with the fundamental social technology of currency, of people's savings, there are consequences to that. And in this great book about the Weimar Republic, I think one of the most interesting summations of inflation in general is this quote. I'll read to you. By a continuing process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens. By this method, they not only confiscate, but they confiscate arbitrarily, and while the process impoverishes many, it actually enriches some. Now, that's a very important point. Now, all these things are derived ultimately, in fact, all these episodes of hyperinflation and these modern, advanced, industrialized, civilized, wealthy nations are derived from a system in which there's one guy or a small committee of people that are in charge of the money supply, that have almost totalitarian, dictatorial control to do whatever they want to do with the money supply. In fact, there was a gentleman named Dr. Rudolf Havenstein, who was the president of the Reichsbank, the German central bank. And even in the early days of hyperinflation, Dr. Havenstein held firmly to his view that the money supply was completely unconnected with price levels and exchange rates. That they could conjure trillions and trillions of marks out of thin air, and in the view of the person who was primarily responsible for making that decision, he said, no, of course there's no link between the amount of money that we conjure out of thin air and price levels. It's ridiculous. There's no link between the amount of money we create and the exchange rate of our currency. That's completely ridiculous. And he actually believed that. That's mad science. That doesn't make any sense. And yet that's the thing we see over and over again. In fact, so many similarities in these episodes of hyperinflation. There's always somebody in control. There's always some committee. There's always some person. There's some central banker, some dictator, some king, somebody who has totalitarian dictatorial control over the money supply. Another similarity is they always have a good reason for printing a lot of money. They always claim it's for the benefit of the people. They say, "Oh, we need to do this. We have this war reparation we have to pay off, or we've got to do this," and they convince people it's their patriotic duty to go along with it. In fact, in many cases, not only people agree, but they like it. In many cases, they even beg for more. They say, "This is what a great idea. Let's keep doing it. Let's print even more money." This is one of the interesting things that happened in France, is when they finally passed this law. They said, "Oh, we're gonna create some paper money. We're gonna print it. We're gonna confiscate all the church property so we can back it up with something valuable." People said, "Well, that's such a great idea. Let's keep doing it." And one of the things that makes people excited is because every time they start printing a lot of money, something interesting happens. Asset prices almost invariably rise. In France, when they started printing a whole bunch of money in the 1790s, everybody's property prices rose. And people were really excited about that because they felt wealthier. In the case of the Weimar Republic in the 1920s, the stock market soared. Stock market went through the roof, and people were making so much money, and they were so excited about it. They felt wealthier because the paper value of their savings was increasing. And these are the sorts of things that happen in these episodes of hyperinflation. They almost invariably start with an asset bubble. They almost invariably start with a rise in the value of the stock market. And people actually look at that and they say, "Hey, that looks great. We should keep doing that," because it makes them feel wealthier. The consequences actually occur later. One of the things that's even more interesting is that in many respects in these episodes of hyperinflation, remember, it happens gradually, then suddenly. It's like an exponential decay curve. It sort of looks like a flat line, and then it just all of a sudden falls off a cliff. And you never really know where you are along that line. Are you right at the precipice of the cliff? Are you somewhere before? Are you almost there? Nobody really knows. We only know when we look back. And we say, well, that should have been obvious. One of the interesting things about it, though, is that nothing really goes up or down in a straight line in these historical periods of hyperinflation. Even the case of the Weimar Republic, there were periods of deflation where you saw, for example, that even as they were conjuring vast amounts of currency out of thin air, all this paper money, that there were periods in this hyperinflationary episode in the Weimar Republic where, for example, the price of gold denominated in these paper marks actually fell. The price of gold got weaker against this paper money. And of course, there are people that looked at it and said, "Oh, you see, there's no consequence to printing money. We can print money because look at the price of gold. The price of gold actually fell. Our currency is strong. Nothing goes up or down in a straight line. There's always these periods of time where a currency gets strong or a currency gets weak or a currency stays put. It goes flat. There's so many different things that happen. It goes up or down. It's the longer term trends that are important. That obviously over the longer term, in the Weimar Republic, the paper currency went into hyperinflation. It ultimately collapsed. And yes, this does happen in advanced economies. Germany was an advanced economy. France was the dominant superpower in the world. These are the sorts of things that happen when we hand over the value of our money supply and we say, here, this is the most important social technology we have, almost as important as something like language, which is obviously an incredibly important social technology. Where would we be if we didn't have the ability to communicate? Money, like language, is a social technology. And when we hand over totalitarian control of one of the most important social technologies we have to an unelected committee of central bankers who, just in their sole discretion can decide, well, I'm going to print, I'm not going to print. I don't see the link between printing money and price levels. I don't see the link between printing money and exchange rates. And we give all the power in the world to these people who are unaccountable, unelected. And then we convince ourselves that we're free and we give them all the control. There are consequences from a system that's built like that. There's a playwright named Elias Canetti, who, interesting guy, he won the Nobel Prize in Literature. He was born in Bulgaria, moved to Germany. He wrote primarily in German. Later in life, this was in the early 1900s. He died, I think, in 1994. Lived a very long life. He saw a lot of things. He saw World War I, World War II, and as the world changed, I mean, when you think about how much the world changed in the 20th century, we saw the rise and fall of the British Empire as the dominant superpower in the world, and the rise and fall of the British pound as the dominant reserve currency. We saw the rise of the United States and 2 world wars and all these things that happened. And as the world changed, Elias Canetti actually moved from Bulgaria to Germany, which was the rising power back then, and then he moved to the UK, which was the dominant power for a while. And he actually became a UK citizen, changed his citizenship to sort of go with the times, and he ultimately emigrated to Switzerland, the place that he felt free and safe, and wasn't participating in war and so forth. And that's actually where he passed away. And He wrote about this in this episode of Hyperinflation. He said, a man who has been accustomed to rely on money, essentially, cannot help feeling its degradation as his own. He's identified himself with it for too long, and his confidence in it has been like his confidence in himself. Not only is everything visibly shaken during an inflation, nothing remains certain or unchanged, even for an hour, but also each man as a person becomes less. Whatever he is or was, like the million he always wanted, he becomes nothing. And that's, I think, so true. Again, in the way that we, in many respects, identify ourselves with money. It's such an important part of our lives. And when its value deteriorates so rapidly right in front of our very eyes, that leaves scars. It leaves deep emotional scars. I was thinking about this today for a number of reasons. For one, it was Ralph Nader, of all people, in his role as a consumer advocate, who challenged the Fed chair, Janet Yellen, on why interest rates are still so low. Now, low interest rates are an interesting thing because, as we, the quote here talking about inflation and so forth, inflation essentially impoverishing many and benefiting a few. The whole idea, by this method, they not only confiscate, but they confiscate arbitrarily. And while the process impoverishes many, it actually enriches some. And of course, that's what happened. If you're a responsible saver, over the last few years and you put money in a bank, my mother does this. My mother loves putting money in a bank. Makes her feel safe. Makes her feel safe to have money because she thinks that it's low risk. And of course, we'll talk about why that's not the case. But if you were responsible and you saved your money, what was your reward? Your reward was 1/100th of 1%. If you wanted to go crazy and get hold some money away and put it in a certificate of deposit, maybe you might get 0.5%. 1/2 of 1%, 1/10 of 1%, 1/100th of 1%. That was your reward for being a responsible human being, for setting aside money for a rainy day and holding it in a bank. And when you think about it, that's no small thing. Banks never miss an opportunity to prove to the world that they are willing to do anything and everything, sell out all of their customers, sell our data to high-frequency traders, manipulate asset prices, manipulate exchange rates, manipulate interest rates for their benefit at our expense. Hardly a month goes by where there's not some criminal investigation, some major fine against a bank for fraud, for wrongdoing, for doing something nefarious with our money. That's our money. And so after the financial crisis, when it turned out, oh, look, the banks had taken our money and gone and made the most idiotic bets in the world, loaning money to dead people with our money, and now they've lost it all. So now they have to get these, now they have to get $1 trillion bailout that taxpayers are on the hook for. And yet then they come back to customers and say, oh, no, trust us with your money. Go ahead and deposit more money in our accounts. I'm sorry, but, that's a little bit more risk than it used to be. Now you've shown your true colors. And for you to say, hey, I know we completely screwed you. And I know now we put you on the hook and we put future generations, just put your children's children on the hook for our stupidity. And we're going to go and give ourselves huge bonuses and record record profits. We're going to put it all in our pockets. But you have to come back and trust us. And for anybody that actually went back and put money in their bank and said, okay, yeah, here you go, even though you completely screwed me and you screwed my kids and my children's children, I'm still going to give you my savings. And what do I get for that? Record low interest rates. Remember, before the financial crisis, that was one of the things that kicked off the financial crisis because interest rates, they felt, interest rates were too high. And back in 2007, 2008, interest rates were creeping up, and you'd actually get 3, 4, 5%. I actually remember getting 5%. What a crazy idea, getting 5%. And now, after the banks blew up, and depositors went back to the bank and said, yeah, hey, I know you screwed me. I know you screwed my future generations. I know you're going to steal this money again and do stupid stuff with it and give yourself record bonuses and all these things. I'm still going to give you my money. And what do I get? I don't get 5% anymore. Now I get 1/10 of 1%. I get 1/100th of 1%. You get screwed even more. This is another way of just bailing out the banks yet again. It's a long, slow, drawn-out process for bailing out the banks. This is the thing that impoverishes some and enriches a few. Who's better off as a result of this arrangement? Banks are much better off because they basically get to borrow our money at a rate that's less than inflation. Even if you believe the government's own little monkey math where they say, inflation is 0.5% and so forth. And they're all concerned because inflation is too low. As if any of us freaks out when we go to the grocery store and we say prices aren't rising enough, and you run home and you yell at your spouse, you're panicked because the price of bread hasn't gone up enough. I mean, these are the sorts of things that only make sense for economists and central bankers, and people freak out because prices aren't rising enough. And even if you believe these numbers and you say, well, even if you don't pay for insurance, or you don't have a child in university or any of these other things where the prices are obviously going up, and you say, okay, well, I'll believe the government monkey math, where they just sort of recalculate inflation in whatever way suits them. And we believe them and say, okay, inflation is still low. Even if inflation is low, getting 1/100th of 1% in your savings account still means that when you adjust for inflation, you're losing money. If inflation is 20 basis points, and you get 1 basis point or even 10 basis points, you're still losing money when you adjust for inflation. And by the way, If you're getting 10 basis points on your savings account, remember, basis point is 1/100th of 1%. So when I say 10 basis points, 10 times 1/100th, this is just financial terms anyway. So 10 basis points means 1/10 of 1%. So if you're getting 10 basis points in your bank account, the federal government's still going to tax you on that. Your state government might tax you on that. So when you talk about, even though you get this little tiny, meager 10 basis point, 1 basis point saving, you still have to pay tax on that. How insulting is that? And then after that, then you lose money on inflation, even if you believe their little monkey math. So when you adjust for taxes and inflation, you're losing money. This is what I was trying to convince my mother about. Is that, look, I know it makes you feel safe, but you're losing money. If you put $10,000 in a bank, you're not going to be able to buy the same $10,000 worth of stuff 2 years from now, 3 years from now, 5 years from now. It doesn't have the same purchasing power as it used to. That's the whole point of savings. What's the point of saving money if it doesn't maintain its purchasing power? That's not savings. That's losing money. You're losing purchasing power. That's the exact opposite of savings. By definition, savings should maintain its purchasing power. And yet, the banking system, the monetary system, the financial system has broken that fundamental promise to be conservative, responsible custodians of people's savings and safeguard the purchasing power of other people's money. That is a fundamental promise in the banking system, in the financial system, that has been broken. And it's even worse in other parts of the world. In Switzerland now, where they've had negative interest rates in their monetary system, now we're starting to see this carry over into the retail banking system. There are banks in Germany that are doing this. There have been banks in Denmark that are doing this. Now there's banks in Switzerland that are passing on negative interest rates to their customers. Where if you want to hold money in a bank, you got to pay rent. And of course, how could that really be that surprising when you got to pay rent to governments now? If you buy government bonds, you buy 2-year government bonds, 3-year government bonds, 1-year government bonds, God help you. You got to pay rent. You got to pay them. The yield that you get is negative. If you loan money to governments that, by the way, by their own definition, are insolvent, your rate of return is negative. You guarantee that you're going to lose money. It's madness. It's complete madness. It doesn't make any sense. And yet, that is the financial system. That is a broken promise to responsible people that have saved money. You guarantee that if you're responsible, you will lose money. And so, of course, this pushes people into stocks, into other things so they can try and generate some rate of return. Of course, people that own the vast majority of stocks, people that are already extremely wealthy and so forth, get a huge bonanza on their wealth. They get to generate massive returns, huge capital gains, and people that are responsible and don't want to take risks and save money, look, saving money in the bank was never going to make anybody, super rich. But it was always supposed to have been an option for responsible people who just want to set some money aside. And now you can't do that anymore without losing money. It is a fundamental promise that has been broken. It's broken in Europe. It's broken in North America. And so Ralph Nader, of all people, challenging Janet Yellen and saying, look, you got to raise interest rates. You're really screwing savers. He signed a letter, the Savers of America, and, suggested that, you really need to start raising interest rates. This isn't fair to people that are saving money. You're undercutting all the people out there who are responsible and saving money. And Janet Yellen comes back and she said that she's very well aware of savers' frustrations. If you're a saver, Janet Yellen feels your pain. She feels it. She's right there with you. You can almost feel the chest bump. And yet, she said, well, even though I feel your pain, even though I'm very well aware of your frustrations, we're just not going to do that. We're not going to just, raise interest rates to certain levels because that would undercut the economic expansion. And all these things, they look at that and said, it's so ridiculous when you think about this system, and they talk about how strong the U.S. economy is and so forth, yeah, it's so strong that if you raise interest rates by 0.25%, the person who's in charge of the entire system feels like that's going to derail our economic growth. That the U.S. is now so sensitive that the only way the U.S. economy can grow is if interest rates are at zero. And if we ratchet up interest rates by even just the tiniest 0.25%, all of this economic growth is going to go away. I mean, how pathetic is that? That in the land of the free, the most productive, wealthiest economy on the planet is so sensitive to the tiniest change in interest rates, and we just can't possibly have 25 basis point rate increase to help the people that are responsible savers. And even though she feels your pain, we're just not going to do it. We're not going to do it. We cannot raise interest rates to a level that at least matches our trivial monkey math official rate of inflation. Now that's pathetic. I find it utterly pathetic. But more importantly, it makes me look back on these historical periods. These historical periods where advanced, civilized, industrial, wealthy nations entered into these periods where they had their unelected committees of bankers, would say, hey, I feel your pain, but I'm sorry, I just don't see the connection between price levels and our money supply. I don't see the connection between our money supply and the exchange rate of our currency. And look, our currency is strong. We're heading into this period of deflation. The gold price is low and all these things. Look at that. It makes me think about these episodes in history. And look, I'm not saying we're going to have some hyperinflation tomorrow in the United States or Europe. Maybe it happens. But I think fundamentally it highlights the incredible weaknesses in a system that's designed where a single individual has all the power to dictate the value of the savings, the value of this all-important social technology that's used by hundreds of millions of people, and one person has the dictatorial control over this to determine what happens to this social technology, the value of this savings, the value in which we denominate, in many cases, the value of ourselves as human beings, and one person is in control over this. And even though all the objective evidence, even their own objective evidence, says, you know what, if you hold money in the bank, you're losing money. And I know it. I feel your frustrations. I feel your pain, but we're not going to do anything to help you. We're not going to do anything to maintain the dignity of this social currency. We're not going to do anything to maintain the value of it, to maintain the value of your savings. One of our fundamental responsibilities, because our economy, which is supposedly strong and powerful and leading the world in growth and all these great things, is so sensitive that if we just raise interest rates by 25 or 50 basis points, the whole thing's going to go off the rails. And it's just such an utterly ridiculous assertion. There are consequences to these systems. There are major consequences. And when you step back and look at the big picture, it turns out, oh, wait a minute. The Federal Reserve, on a mark-to-market basis, is insolvent. The U.S. government is insolvent. Every major pension program is insolvent. The U.S. banking system is extremely, highly illiquid. There are consequences to a system like that. Maybe it's hyperinflation. Maybe it's inflation. Maybe it's deflation. Maybe it's any number of things that could happen. But to simply presume that everything's all good and it's going to go on and continue like this forever, and we've got one person who's in charge of the whole thing, and I'm sure the committee of central bankers, they're all very smart people, so let's just trust them to be smart guys and continue on, pulling all the levers and dials and pushing all the buttons to command the entire system in their sole discretion. I'm sure that's just going to go on just fine forever, and there will never be any consequences. That's utterly foolish. Now let's dial it back and look at the banking system. Because I want to talk about this. I've talked about this a lot. I say routinely that many of these banks, in banks and banking systems, we have a number of risks. We're sort of brainwashed in believing that in banking systems, there's never any risk. It's a bank. It's risk-free because it's backed by the government. It's backed by the insurance fund, by the FDIC and so forth. Oh, wait a minute. Hang on. The government is insolvent. The central bank that supports the government is insolvent on a mark-to-market basis. The insurance fund that's supposed to back up the banking system that's supported by the government is itself undercapitalized and fails to meet the minimum solvency requirements that are set forth by law. And they got the banking system itself. Oh, yeah, those guys, the guys who loaned money to dead people with our money. The guys who indebted future generations to bail out their own stupidity. The guys that never miss an opportunity to, collude and fix exchange rates and interest rates and asset prices and everything they can possibly screw us on to sell our trading data off to high-frequency traders so that other people can go out and siphon off tens of billions of dollars out of financial markets at our expense. Those guys are not risk-free. Even though they're backed by, undercapitalized funds and insolvent governments and borderline insolvent central banks, they're clearly not risk-free. And there are risks in the banking system. I would tell you that there's 4 primary risks in the banking system to be aware of. Number 1 is fraud risk. And unfortunately, this is not a risk that is zero. There's a lot of fraud that happens in the world of banking. We read about it in the headlines all the time. It's out there. The whole idea of giving a stranger your money because they're regulated. So was Enron. Bernie Madoff was regulated. I mean, simply put, we see this stuff all the time. There is fraud in the financial system. Then you talk about solvency risk. This is Lehman Brothers 2.0. Lehman Brothers. So many banks that went under. When a bank goes under, when its liabilities exceed its assets, no longer able to pay its debts, it's no longer able to pay back its depositors because they've lost so much money. Solvency risk. Because they've gone out and they've loaned money to dead people, and it turns out maybe that's actually kind of a stupid idea. And the value of their assets tanks. All the bonds that they buy, the value of their bond portfolios, the value of their asset portfolios, all these things go down in flames. And they try and stave it off. They have a lot of clever accounting tricks. We did an entire podcast on this one time, probably about a month and a half ago, talking about how banks use these clever accounting tricks to manipulate their asset prices, their asset portfolios, to change things from available for sale, booked from available for sale into hold to maturity. And we've seen these skyrocketing rates of banks rotating their entire bond portfolios from available for sale, where they have to market value, to hold to maturity, where they say, oh, no, it doesn't matter if the value of our bonds has gone down. We're not going to book those losses. It's a very clever way for banks to hide losses in their bond portfolio. And yet, the reality of the situation is that their solvency levels are much lower than they claim to be. Another major risk is liquidity. To me, this is one of the biggest risks in almost every banking system, is how much of your money do they actually have? When you go and you deposit $1,000 in a bank, they don't keep $1,000. There's no vaults that's sitting back there with $1,000 in cash neatly piled up somewhere. They don't keep that just kind of laying around. They don't keep it in cash. They don't keep it in central bank deposits. They go out and they go out and make stupid financial decisions with it. They go and make bad loans. They go out and buy bonds, and then it turns out when their bonds lose value, they rotate them into hold to maturity. And they say, "Oh, we're never going to sell these ever." Well, if you're never going to sell the bonds, then it means that you're never going to be able to pay me back my money. They go out and they make bad loans. They go out and make bad investments, and there's very little actual liquidity remaining in the bank. In terms of their cash equivalents as a percentage of customer deposits is extremely low. With many banks, it's as low as 1%, 2%, 3% of your money. That's an extremely low level of liquidity, which means that if any real meaningful percentage of customers wanted to withdraw their money or transfer it outside of the banking system, the banks wouldn't be able to do that. They'd have to start selling assets. It'd be a fire sale of assets. And again, I always say this, if you don't believe me, then just go down to your bank and ask them to withdraw not even a huge sum of money. Go ask them to withdraw $20,000, $25,000. I mean, in a banking system where there's trillions of dollars in payments every single day, $25,000 is not that much money. Let's be honest. $25,000 out of trillions of dollars is it doesn't even register as an atom within a drop of the bucket. And just go see what happens. See how much, they'll be from my cold dead hands, are you going to take your money out of this bank? They'll come up with all kinds of excuses. They'll start treating you like a criminal terrorist because you have the audacity to want your own money back. It's because they don't have it. It's because they don't have it. And again, that's another fundamental promise in the banking system. When you give your money to a bank, the bank's supposed to keep it. They're supposed to be responsible custodians of other people's money and safeguard the purchasing power of their savings. It is a fundamental promise that continues to be broken. And we see this over and over and over again. Now there's so many more risks of the banking system, we're starting seeing negative interest rates. And even in the United States, we have this negative interest rates in many places in Europe. Now we're seeing this as well in the United States, and they start asking this question to people in the Federal Reserve, and they say, well, what about negative interest rates? And they say, well, we haven't ruled that possibility out. Well, wonderful. They haven't ruled it out. It's very much on the table. How long until that happens? Just consider it like this. Every time there's a recession, what does a central bank do? They cut interest rates. Now, when interest rates are already zero, and maybe next month they decide to increase interest rates by that, all-important 25 basis points. Okay, fine. So maybe interest rates are 25 basis points, maybe even 75 basis points. When there's a recession, particularly when it's a rather significant recession, what do central banks do? They cut interest rates. So if interest rates are at 25 basis points, 50 basis points, and they have to go and make a 75 or 100 basis point cut, what happens to interest rates? 50 basis points minus 100 basis points equals negative 50 basis points. You end up with negative interest rates. I mean, it's almost a mathematical certainty at this point that in the land of the free, there's going to be negative interest rates. How could there not be negative interest rates unless you want to presume that there will never again be a recession in the United States? And how foolish is that? There are always recessions. It's part of the cycle. There's always recessions. You can go back and look at the economic history of the United States. There's always recessions. In fact, in many respects, they come along every 6 to 7 years. We're due. It's time. It's time for another recession. The clouds are forming. There's so many of these indicators out there. You look at what's happening in China. You look at all these things that are happening all over the world. It's time. Not to mention the fact that they're trying to start World War III. It's time. And what are they going to do? Interest rates are at zero. Yeah, maybe they get it up to 25 basis points. They're going to have to slash interest rates. That means negative interest rates. This is something that's going to happen. And so there's another risk. You've got fraud risk. You've got all this immoral activity, selling customers out, manipulating this, manipulating that. You've got solvency issues. You've got these guys, manipulating their own books, using clever accounting tricks to hide their solvency issues. You've got major liquidity problems. And now we're going to have to deal with negative interest rates. Is that really safe? Is that the height and paragon of safety for your savings, knowing that you're going to give your hard-earned savings to a bank that's got a history of screwing you and unborn generations for their own stupidity, that's going to go out and do stupid things with your money? It will hardly keep a penny of it actually there, still at the bank. It's going to go out and make bad loans. It's going to hide its solvency issues, and then it's going to charge you money for the privilege of all of that. On what planet does that make any sense? And that's the banking system. That's already the system in Europe. And it's coming to the United States. There has absolutely got to be a better way. And there are. And I want to talk about some of these as options and solutions, because the whole point is that, I mean, one of the key themes I think at Sovereign Man is that, we see risk in places that other people think are perfectly safe. You start talking to people about risk in the banking system, and people think you're nuts because we've been brainwashed for our entire lives. Oh, it's a bank. It's safe. I'm sorry. I actually live in the world where data matters. I live in a world where numbers actually matter. Not just some brainwashing propaganda. And when you look at the actual numbers, this is not some crazy conspiracy theory talking about banks. They put this data out every single quarter. Banks publish their own financial statements. You can see the numbers for yourself. You can see the great rotation from available for sale securities into hold to maturity assets and wonder, gee, why in the world would a bank suddenly rotate 50, 60, 70% of its bond portfolio into an asset class, saying that we're going to hold these forever, even though they pay interest rates, they pay yields that are below the rate of inflation? That seems rather convenient. Oh, it turns out they don't have to book their losses anymore. They don't have to show losses on their balance sheet. That's very convenient. We can also see that banks hold a tiny, just smidgenly fractional tiny little piece of their customers' deposits in cash and cash equivalents. That we can see what the level of central bank reserves are. We can see every week the Federal Reserve publishes its own balance sheet. We can see that the Federal Reserve's capital is a tiny 1.3% of its total assets, and on a mark-to-market basis, it's basically zero. Some weeks it's even less than zero. This is all publicly available data. This isn't some wild and crazy conspiracy theory. These aren't even my own calculations. The banks, the central banks, the government, all this data is out there. It's right there. And anybody that cares at all, anybody that gives a shit, can see this for themselves. It's for most people, say, oh, it's all good, it's fine, it's a bank. Of course my money's safe. That's a very dangerous assumption. It's an incredibly dangerous assumption. You wouldn't just go up on the street to some bum and say, oh, here you go, here's all my life savings. I'll come back for it at some point, but here, you just hang on to that for now. I mean, nobody would do that. But you wrap it up in a nice building with a fancy cornerstone and marble tile in the lobby, and, so we got no problem. You put some government seal on it, it's all good. And, even though we know that the government's broke, we can see these guys constantly bickering and arguing about, oh, that's going to be another shutdown, the shutdown's looming, all this, but it's fine. We put a government seal on something, we think it's going to be okay. It's ludicrous. It's absolutely ludicrous. And the only reason that state of mind, that mentality exists is years and years and years of this propaganda that makes us think, well, it's the government, it's all good. It's going to be just fine. There are real risks. And what's interesting is that where there's risk, there's always opportunity. There's opportunity in the risk itself. We talk about this a lot. When there's this sense of perceived risk and actual risk. When the perceived risk in something is very high, and the actual risk is low, because look, oftentimes the perceived risk and the actual risk are completely different. There's the risk of what people think is the risk, but then there's what the real risk actually is. And oftentimes those two are completely and totally different. You look at something like, skydiving without a parachute. The perceived risk and the actual risk are probably the same. I can all imagine that skydiving without a parachute, the risk is very high. The real risk is probably very high. But then there's so many other things where the actual risk and the perceived risk are completely and totally different. In some respects, the perceived risk is extremely high, but the actual risk is very low. You could say, actually, talk about skydiving. That might be a great example. In fact, many kind of adventure sports, where people think, it's terribly risky to jump out of an airplane or, even to go swimming with sharks. And these sorts of things, and we think the perceived risk is actually much higher than it really is. Not to say it's risk-free, but the actual risk is much lower than what people think it is. I point to emerging markets for investments. We're about to buy some real estate in Colombia, for example, and you hear the word Colombia, and people think, oh, Colombia, that's where you get kidnapped, and it's all these terrible things. And we're about to buy this gorgeous property. I mean, absolutely gorgeous, top of the line, super luxurious, for less than the cost of construction. I mean, you couldn't build it for probably even 50% more than it's selling for. And it happens to be in one of the nicest neighborhoods and one of the nicest cities, in a place where they're not even issuing building permits anymore. So the supply is fixed, the demand is increasing, and so forth. Yeah, of course, there's risk in any investment you make, but the actual risk is much lower than the perceived risk. Oh, by the way, the Colombian peso hasn't been this low in years and years and years. The dollar is incredibly overvalued. So I'm able to trade into a currency that's hit this massive low, and yeah, it could even get weaker. But for to buy a property for less than the cost of construction in a landlocked area where they're not issuing building permits anymore, where supply is fixed and falling and demand is increasing, the actual risk is much lower than the perceived risk. And anytime that's the case, that's usually the time to buy. When people think you're crazy and the fundamentals stack up so soundly, that's a great time to buy. That's a great opportunity. Now you've got the converse, or is it the inverse? I mean, it's the inverse. Or is it contrapositive? Somebody help me out. This is when the perceived risk is low, but the actual risk is much higher. This is the banking system. The perceived risk in the banking system is low. So people say, oh, it's a bank. Must be fine. There's no risk in the banking system. Of course there's risk in the banking system. You got fraud risk. And if you think there's no fraud risk, then you need to start reading a newspaper. Open your eyes. Look at the TV. Look at the news. Just Google some stuff and you'll see fraud risk is very significant in the banking and the financial system. Read about MF Global. I mean, all these things, there's a lot of fraud risk that's out there. Solvency risk is clearly there. Liquidity risk, clearly there. Negative interest rates. There are real risks in the banking system. These risks are not zero. And the perceived risk is basically zero. People say, oh, it's a bank. It's all good. No, it's not. You've got a bank that's got fraud risk, solvency risk, liquidity risk, negative interest rates, backed by an undercapitalized insurance fund, backed by an insolvent government, supported by an insolvent central bank. That is not risk-free. It is just common sense. It doesn't take a rocket scientist. You don't have to be some financial wonk to figure that out. The perceived risk is basically zero. The actual risk is much higher. I'm not here to tell you that the banking system is going to collapse tomorrow. I'm not saying the risk is, there's some 100% risk of loss, but it's a hell of a lot higher than zero. It's a lot higher than the perceived risk. And so there's that disparity again between perceived risk and actual risk. That as well is an opportunity. It's an opportunity to take action, to mitigate the risk, to do something, to sell. If it's an investment, that's time to sell. When the perceived risk is low, but the actual risk is very high, that's time to get out. In this case, it's time to take action. It's time to do something. And so I want to spend the last few minutes here, we've been going for a while, I want to spend the last few minutes here talking about a few solutions. There are risks in the banking system. There are risks in the financial system. There are risks in the monetary system. How do we deal with that? I want to talk about a few things. The first is, this one's an easy one, cash. Physical cash, physical currency. $100 bills. 500 euro notes, if you can get your hands on some. 1,000 Swiss franc notes. Physical cash. Physical cash is a great hedge against problems in the banking system. It is I will be very clear, short-term solution to hedge risk in the banking system. If there are real problems in the banking system, cash is going to be all-powerful. if there's a huge banking crisis, or there's another, if there's another recession, if there's another 2008, if there's another big Lehman moment, if there's another global financial scare, and come on, like, let's not be Pollyannas and assume that, oh, it's all good, there's no risk out there in the financial system. Give me a break. Come on. Let's be realistic and say there's a lot of risk out there. Maybe it doesn't happen. Maybe we get really lucky. And we're able to just go on and there's no huge crisis. Okay, great. Then who cares? You're not worse off for having cash. What difference does it make? If you got, $10,000 in the bank, or you got $10,000 in cash, you're getting paid 1/100% in the bank. You get 0 with cash. Big deal. Big deal. You're not going to miss that 1/100%. The risk in the banking system is not worth 1/100%. Just take out some money. You don't have to take out all of your savings. Just take out some savings. Hold some physical cash. Get a little safety deposit box. Keep it somewhere safe. You can have there's a lot of options. You can keep it, keep a little safe in your house. I wouldn't recommend holding cash in a safety deposit box at a bank, but there are private storage facilities, private secure storage facilities. You can look at these places. There are a lot of them all over the place. I've dealt with several of them in the United States and different parts of the world. Something like that. But even just a little safe in your home. Lots of interesting places. Just don't forget where you put the cash. Don't be that guy that goes and is just so just trying to be so super sleuth. You put it in different pages of books and all those things, and you forget where you put it. Just put the cash in a safe place. Lock it up somewhere. Maybe have a safe in your home. I have a safe in everywhere that I go. I always have a safe when I stay in hotels. It's always safes. I put valuables in a safe. Pretty basic stuff. But if you hold cash, it's a great short-term hedge, because if there are problems in the banking system, and maybe we luck out and there are no problems in the banking system, maybe nothing ever happens. The risk is there, but maybe the problems never rise. And great. Hey, if we luck out, fantastic. But if there are problems and these risks turn into real hazards, cash is going to be absolutely critical. Because now, look what's happened in Greece. Look what's happened in Cyprus. All these things. When these things happen, when there's problems in the banking systems freeze up. They have bail-ins where they say, oh, we're going to freeze all customer accounts. We're going to grab customer accounts over a certain amount and give that money to the banks. We're going to freeze people out of their savings. We're going to have exchange control. We're going to have capital controls. We're going to prevent you from withdrawing money from an ATM. If you have cash, suddenly you sidestep all of those problems. You're not going to have to worry about how do you pay your rent, how do you put food on the table for your family. You don't have to worry about any of that stuff because you have physical cash, and it's still accepted as a medium of exchange. As long as cash is accepted, you're going to be okay. And so having some cash makes sense. Some physical cash makes sense. Now, I'm always all about trying to state risks, and even something like cash is not risk-free. There is the risk of loss and theft and so forth. There's some physical security risk to cash. That's easily mitigated. Again, just taking some common sense steps. But then some other issues. Civil asset forfeiture is on the rise in the land of the free. Since 1986, since they started collecting data, curiously enough, they passed this law in 1984. Rather ominously, in 1984, they passed this very Orwellian law in the land of the free, kind of authorizing civil asset forfeiture and confiscation of private property of citizens. And they started collecting data in 1986. So from 1986 to 2015, the sort of dollar value of private property that has been seized by private citizens, that the government has seized from private citizens, has increased at an annualized rate of 21.4% since 1986. So if you cruise around town or get on the federal highway system, and you got $5,000 sitting in your car, which, by the way, is not illegal at all. It's not illegal to have cash. It's not illegal. You could have $25,000 in cash in your glove box if you want to. And yet, if you get stopped by a cop can, in his sole discretion, say, yep, I'm going to seize that cash because I think that what you're doing is wrong, and so I'm just going to seize that. And even though you think that you're innocent until proven guilty, it turns out that's a bunch of bullshit. Because they seize that outside of the court system. They seize it administratively, putting the onus and the burden of responsibility on you to prove your own innocence. You have to spend a lot of money and time and resources and attorney's fees and all these things to go back and get your own cash back from the cops who are there to serve and protect. That's banana republic stuff. And yet that's the way of it in the land of the free. And this is on the rise. So be careful with cash. If you cruise around with a lot of cash, you can be relieved of it. Then there's all these other issues. I mean, there's these complete idiots talk about, oh, we need to ban cash. And of course, that's very convenient for banks. It's very convenient for politicians and so forth, because they can't control cash. If they impose capital controls, if there's serious problems in the financial system, the first thing they do is impose capital controls. They did this in Iceland. When they went bust, they did this in Greece. They did this in Cyprus. They do this in Argentina. Capital controls they're the logical next step in a financial crisis. And if you have cash, you can sidestep capital controls. So of course they don't want that. So they say, oh, we're going to ban cash, or we'll create capital controls against cash, or we'll just criminalize it. Anybody who has cash is a criminal. And they'll come out with all these ridiculous things about cash. They'll say, oh, cash is used to finance terrorism. And so only terrorists use cash, and they have all this sort of thing. And so they'll use terrorism for anything. For anything. I mean, in Europe now, the Europeans are now, they say, oh, we need access to the, SWIFT payment data. SWIFT, of course, is the Society for Worldwide Interbank Financial Telecommunications. It's a clearing system. So if you've ever sent an international wire transfer, it goes through the SWIFT payment network. And so now the European government is saying, we need access to all that data because of terrorism financing. And so they'll do the same thing. They say, oh, cash, we have to ban cash because that's what terrorists use. So cash is not risk-free. It's a good idea, but that's why I call it a short-term hedge against problems in the banking system. Another solution to consider is a foreign bank account. Opening a bank account, having a bank account in another country where the risks in the banking system are substantially lower, where the banks themselves are liquid, where they're solvent, where they don't have a history of fraud, where they don't have negative interest rates, where there's a well-capitalized insurance fund, where there's a solvent government. And so having a bank account in a place like that is substantially lower risk. And so if you can move money from a higher risk banking system to a lower risk banking system, that's a good solution. That's something that can make a lot of sense. That is also not risk-free. The reason is because these situations change. Banks change, bank solvency levels change, bank liquidity levels change. This is one of the things that we do for our premium members, is we kind of maintain sort of constant awareness and monitoring banking systems and banks and so forth around the world to figure out who's rising, who's falling. It's not entirely risk-free, because a bank and a banking system can go over. It doesn't happen generally overnight, but over time we can see that certain banking systems go from being very well capitalized, to being less capitalized, to being very liquid, to being less liquid. And so these are things that you have to watch out for. In general, it doesn't make sense to just park your money somewhere and just assume away until the end of time that your financial partner is stable, solvent, and highly liquid. It just doesn't make any sense. It makes sense from time to time to check in. Give your financial partner a little checkup and say, "How you doing? Let's see your vitals. Let's see your financial statements. Are you liquid? Are you solvent? Are you stable? Are you profitable? And if not, maybe it's time to make a change." Another solution that makes sense, you won't be surprised to hear me say this, is gold. Gold becomes not necessarily a short-term solution, but a long-term solution. As well, not only against problems in the banking system, but problems in the financial system as a whole, problems with the monetary system as a whole. If you get into a situation where there's a real, the problem with cash is that if there's a real currency crisis, And if there's problems in the banking system, cash is a fantastic solution. Physical cash is going to be your best friend. But if there's problems, if problems in the banking system, if problems in the debt markets, if your government's solvency level, if your government's debt level becomes a huge issue, if your central bank becomes insolvent, it creates a currency crisis, physical cash could very quickly become worthless. You want to have something else that can stand the test of time. What's an asset class that has a 5,000-year history of standing the test of time? Gold. Gold and silver, precious metals. Precious metals are a great long-term hedge against problems in the banking system, in the financial system, in the monetary system. As a whole, you want to have your hands on something that's real, a real asset that's portable and liquid and has a tradition of being widely accepted around the world at this particular time. Maybe this changes in the future. Who knows? But at this particular time, gold and silver do make a lot of sense. You can go just about anywhere in the world and be able to trade gold for something, even if it's for other currency. And so that makes it a great hedge against risk in the financial system. It doesn't mean to hold 100% of your savings in gold or 100% of your savings in cash. But having some gold as a form of savings, as some emergency savings, as a rainy day fund, does make a lot of sense. Again, also not risk-free. Over the short term, gold price is going to go up and down. When denominated in paper currency, gold price is going to go up, gold price is going to go down. There's also the possibility of some capital controls, some violation, some outlawing of gold. If you think that would never happen, of course it does. It's happened. It's happened in the United States. When Franklin Roosevelt was inaugurated and he gave this amazing speech and he said, "We have nothing to fear but fear itself." And 2 days later, he closed the banks and confiscated Americans' gold. It happened. And so having all of your gold, with you, having some gold makes a lot of sense. Keeping a portion of your gold in a safer jurisdiction overseas that's not bankrupt, that's not insolvent, that doesn't have some huge looming debt crisis and so forth, where the risk of capital controls and so forth is much, much lower. Having some gold stashed away in a safe place overseas, particularly a place overseas that you might want to go to someday, that makes sense. Having some gold with you also makes sense, but there is some risk in gold. There's that short-term risk of the fluctuating gold price, and there's also some risk of capital controls that come in and say, we're going to outlaw gold, we're going to criminalize gold, we're going to tax all the gold holdings, we're going to have a wealth tax on gold, we're going to have a windfall profits tax on gold. So there's some risk. You can hedge those risks by keeping a portion of your gold overseas. Doesn't have to be a whole lot, but just some emergency savings. It's like having an offshore bank account. The only difference is it's an offshore bank account for your gold. This is something that makes sense. Last thing I want to point out, for whatever reason, this is still controversial for some people, but I think that digital currency, I should be more specific and say decentralized cryptocurrency, is also something that may make a lot of sense. I quite like these concepts. The concept of Bitcoin, the future of cryptocurrency might not be Bitcoin per se as it exists today, but the concept is incredibly elegant, and we've been going here for a while, so I'm not going to really get into the beauty of a decentralized cryptocurrency. But it is not something, it's something that is very hard to enforce capital controls on cryptocurrency. And in an era of hyperinflation or even significant inflation and so forth, cryptocurrency is something that can make a lot of sense. It's never really been tested in an industrialized, advanced economy, but certainly in other places in the world that have gone through financial crises, Greece, Cyprus, etc., Argentina, the value of cryptocurrency, being able to walk across borders with thousands, hundreds of thousands, millions of dollars worth of cryptocurrency, written down on a string of paper on a bookmark, or in your mobile phone. There's a lot of power in that. Being able to move money, in a private way, outside of the primary government-controlled, government-dominated clearing networks, banking systems, and central banks and so forth, being able to exist outside of that, there's a lot of power in that. And whether or not you think it's a scam, I always say if you think Bitcoin is a scam, then you probably haven't educated yourself enough about it. Whether or not you think it's a scam, whether or not you understand it, whether or not you agree with it, whether or not you think it makes sense, whether or not you think, oh, it's just, it's just it's just something else that only has value because we agree it has value, and so on and so forth. There's a lot of skepticism about it. Skepticism or not, it's coming. The financial system is changing, guys. It's absolutely changing. This paper money, central bank dominated financial system is a thing of the past. It's on the way out. There's no reason why in 2015 the financial system as it is today should still exist, because all the technology that makes it better, faster, cheaper, more efficient already exists, and it's coming. It's called financial technology, fintech, in startup speak. Fintech companies are out there, and they're going to change the world. They're going to change the world of finance for sure. It's already happening. It's absolutely already happening. And banking as we know it today isn't going to exist in 10 years. It's just all the technology exists. It's just a question of how quickly it's going to be adopted. Bitcoin, cryptocurrency is a part of that. It's coming. And so understanding it, even if you don't use it, understanding it is a good investment of your time. But I am here to tell you that there is benefit in owning some, because it's a nice, easy way to hold money, something that's transportable, easily transportable. We're talking about digits. We're talking about a string of characters on a piece of paper that you can write down, that's your code. There are so many advantages to this, to holding this outside of the system, and something that does already have, even in its relatively short history, examples of being a major, incredibly beneficial in places where there have been serious financial crises. So it does make sense to have something like this. So we talked about cash, we talked about foreign accounts, we talked about gold, whether held domestically or overseas, we talked about digital currency. These are all solutions. There's nothing that's risk-free. Holding money in a bank, certainly not risk-free. But there are solutions. Even the solutions have some risk. And it's important to understand those risks. But these are things that make sense no matter what. You're not going to be worse off for having a little bit of cash sitting in a safe, in your home somewhere. You're not going to be worse off because you own a little bit of gold. You're not going to be worse off because you move a portion of your savings to a jurisdiction overseas where the banks are solvent, well capitalized, have limited instances of fraud, don't have negative interest rates, are backed by liquid, solvent central banks and governments with no debt. It's hard to imagine you'd be worse off for something like that. And so all these things are things that make sense, and they're good solutions to a system where the perceived risk is low, but the actual risk is very high. They're good solutions for a banking system, good solutions for a monetary system where a single person can say, I feel your pain, but we're not going to do anything to help. These are all solutions. They make a lot of sense. All it takes is the will to act. It's not complicated. It just takes a little bit of effort. The desire to learn about these things, the education to learn about these things, these are important trends. What's happening right now? These are enormous historical trends. They're unfolding right before our eyes. The dominant superpower is changing. The dominant reserve currency is changing. The global financial system is changing. And this has happened so many times before throughout history. And each time these changes bring significant risks and significant opportunities. So let's have our eyes open to both and have the will to take action. Thanks very much for listening, guys. We'll talk to you again soon.